Good evening, everybody. This is Paul Duncan. It's Valentine's Day 2016. So let me give you a brief update of the weekend. Yesterday I gave a face-to-face seminar and we covered a number of things, so I thought I would just go over those in at a high level just so that you can see what I'm seeing. Talked yesterday about the Dropbox, and within the Dropbox are a number of files. And so for those of you who are subscribers, when you get to the Dropbox, you're going to see a couple files in there, and it builds throughout the week, and then I clean it out on the weekend because some of you are free members and you're limited to 2 gigabytes, and so I try not to fill up your hard drive with a bunch of stuff. So by Friday or Saturday, the previous week will be removed, and you'll have to have saved it to your local drive. So yesterday's seminar is in here. I've got the actual meeting notes and everything there that we talked about, and to go along with that is a video of the actual meeting, and I was recorded from GoToMeeting. So you'll be able to follow the dialogue. It's fairly long, so you can speed through different sections or listen in sections as necessary. One of the things I talked about yesterday was simply the 2 different files that are in there. One of them is an ETF file, and one of them is a stock file. So let's look at the ETFs. The ETFs I don't use too much. I don't invest in ETFs as a matter of principle. I do like individual stocks. The thing here, though, is that it gives you a very good snapshot of the market, and the way I've got it structured is on the dashboard tab of the ETF file. I've got the major indices broken out by the S&P, the NASDAQ, Dow Jones, etc. And you can see where you have a long rating. We have a preponderance of favoritism to the downside, and you can see that for each of the indices. And in addition to that, you can see that for oil and gas, the short side of oil is being favored. And in terms of the broad ETFs, this is just a summary of what we're seeing up here, and you can see that there's a lot of favoritism again to the long side. Now, Friday was an up day, and as you would expect, the negative prices on the short ETFs or the contra ETFs means not a lot for one day, but if we get sustained days where we have a bunch of down days, you'll start seeing these flip over to cash, and you'll start seeing the cash side flip over to long. So I want to keep an eye out for that. Gold is being favored right now, and it's been favored for a while. I'm not seeing, you can still see some green that's occurring in here, although you do see some red. So perhaps we're getting closer to a top, perhaps we're not. The key takeaway is that some of these stocks, this is the GGT signal, and had we followed these signals judiciously, we would have been up in our portfolio on these positions at least this amount, if not more. Looking down here, financials, the shorts are getting, the contra side of the financials are being favored, whereas the long positions, especially the XLF, which is got a lot of volume, over 100, almost 100 million shares, is still being pummeled into the ground, although Friday was an up day, so that's something worth looking at. In general, the ETFs can give you a broad market view, and if you like diversification, picking any one of these and investing in it is as good as picking 20, 30 stocks. You're going to dilute your possible earnings, but then again, you can follow things along. This column right here tells you what the GGT signal would have resulted in had you followed the signal from the beginning, and you can see that in many cases you would be up by listening to what GGT has to say. So that's one of the stock files that's posted nightly, or one of the ETF files that's posted nightly, and it's something that you can use. The other one is a stock file. In fact, let me change, instead of opening this one, let me go to the one that I think is more recent. Yeah, that was from last night. So I've actually done some work today, and I'm going to close this and open up the one that I've been working in today. Yeah, it's this one. A lot I don't expose to you, as you can imagine. Try to keep the noise down and just try to keep the information flow going as necessary. All right, we'll update that. Hit continue. Okay. So one of the key things to look at here is when you first come into this, it could be on any one of these tabs down here. More than likely, it'll be on a metrics tab or any of the ones that are to the left of it, dashboard, watch list, or portfolio. The metrics, this is showing us the number of long-rated stocks in the database, and in this particular case, you can see that we've been falling. This is a standard deviation line, so buying when we are south of that line is usually a good idea. It usually works out, and selling when we are north of that line typically works out. You can see that we're south of that line, and that's a good thing. I don't advocate necessarily buying today, but it's you know, the market is primed for that type of environment. The dashboard is where I make a lot of annotations on stocks. I really have them broken into 3 groups. One of them is the greenfield dividends, so all of the stocks that follow are dividend payers. All the stocks south of the no dividends are not dividend payers, but they meet my greenfield criteria. And then the parking lot are stocks that have a violation of one or the other, but I've done the work on them and I don't want to discard them, so I just move them down to the parking lot once they fail a given criteria. What criteria are we talking about? Well, let me go ahead and just get in here. And I'll show you what I'm talking about here. So while this is loading, let me go ahead and pull up one of the ETF or one of the stock files here. So when we look at the greenfield dividend stocks, oops, sorry about that, folks. When we look at the greenfield stocks, you're going to notice that over here on the right hand side I've got a link to charts and a link to the SSG. So I've done some analysis already on these stocks, and the nice thing about that is if you go to, here's row 1, if you go to that little cell just above row 1 and you click it, the whole thing turns. And if you come up here to data and then hit filter, you see these little arrows, pull downs up here. And what I'm going to do is I'm just going to go ahead and I'm going to turn off the cache signals. So I'm just leaving the long signals that and the blanks that you see here. And so we got blanks. These are because these are new updates and I haven't got them integrated into the database yet, and that'll happen this week. What we're left with is we're left with all the stocks that are dividend stocks that are you know, getting a recommendation of looking positive within this overall market climate. What's probably more important is that if we take a look at some of these stocks are doing, you know, pretty well overall. I'm just going to go ahead and pick one arbitrarily. I don't really care. Looks like let's see, new long. So FLIR looks like it just went on Friday to a new recommendation. So prior to Friday, this had not been doing very well, and it had been sitting more or less in a cash status, and demand hadn't been very high for the stock. On Friday, volume and price went high, which caused it to transition to this new long recommendation. Now, what does that mean? Well, we can take a look at what's going on with this stock. So over here on the right-hand side, I've got 2 links. One of them is to a chart. I'm just going to go ahead and copy that, open up Google here, and just throw it in. And so on Friday we had a spike upward. So not that FLIR or FLIR is a great stock, but it does have a good presentation just for an initial review. This is obviously the closing or the actual prices during the day. Trailing EPS looking back into 2011 so it's about a 5-year history. I don't like this, but I do like this. This is good. This is increasing EPS in recent time frame. Because the EPS has been going up and prices have been coming down, we're seeing the PDE ratio, the price to earnings ratio, come down. And the other thing I like here, obviously, is that we're seeing some improvement of dividends. And so I like this presentation of where we're increasing dividends on a year-over-year basis. Always a good thing. So when we go back and we look at FLIR, we see that it's actually doing pretty well. The trailing 12 months EPS is doing well. It's been doing well for 5 quarters. Not doing so well, though, in some other areas. So the pre-tax profits have fallen for the first quarter. We've also got sales that are decelerating for the first quarter. And overall, sales on a trailing 12-month basis are really anemic. Really slow, 3.8%. So not very good. Now we can take a look at that. I've done some analysis, and I'm just going to grab this column that says link to SSG. Go ahead and we'll just paste that in here. This is going to link you to a file within my Dropbox. And you can see that sales are indeed, they are flat, relatively flat. I've signed only 1.7% gain there, so not very well. I just matched obviously what we see here in the last quarter over quarter, and that's because they are relatively flat here. Pre-tax profits are coming down. That's not necessarily good, and that's a 5-year trend line, but you can see they did bump up in the year, so we do have, you know, probably a better performance than what I've listed here. Earnings is interesting. Earnings is actually taking off, and so I went ahead and built whatever that earnings line was. You can see 40%. That's not sustainable. I probably capped it. Yeah, so I capped it up at 13.9, and that's probably the slope of this line from last year to this year. That matches the slope of this line. So I'm estimating in 5 years, here's what their sales are going to be, here's what their EPS is going to be. Doing all of that and pumping it in through a lot of this allows us to start estimating, is this in a buy zone? And right now the price of 29 is below, is between the values of 23 and 42, which this methodology suggests is worthy of buying. What's probably more important is we can take a look at the trailing 12 months, and we can see that sales on a trailing 12-month basis, and you can see right over here, it is a trailing basis. Let me make this so it fits. One of the things that we can see here is that earnings are really doing well. Even sales are doing well. I mean, it's positive, right? So here's the 0 line, so we're positive. So on a year or a quarter-over-quarter basis, we are still gaining. This hasn't gone negative, so that meets one of my criteria. Earnings are really doing well, though, and that's remarkable for a stock like this. In fact, these numbers are not sustainable over the long haul, so hence why I've probably locked it into a much lower number, representing probably close to the ceiling of these numbers looking back at the history. I take a look at the earnings here, and I try to project what's going to happen as we go forward. Bottom line is that you can do this for any of the stocks that that are listed here, and the key here is that sales are not doing very well, as you saw. We're getting a slight deceleration, and even though we got a new long on FLIR, I wouldn't be so inclined to invest my money into it, not with this recommendation. Contrasting, if we flip over to the watch list, there are a number of stocks over here which I think are probably worthy of our hard-earned money. You see a lot of green in this area, and this is the accelerating sales, EPS, and pre-tax profits area. A lot of the stocks in this area, look really good. And so, for instance, we were just looking at one stock that looked like it was decelerating. This one, Crane, looks like it's doing pretty well. And these aren't recommendations, by the way. I just want to show you how to use the system. So again, I'm just going to go ahead and pull that link, and let's go look at it real quick. And And so this is just make sure it says CR, yeah, and they're good. And you can see the EPS not great here. I like to see a lower left to upper right, and we're not seeing that here, but we are starting to see some gains here. That's good. We're seeing the EPS come down, and of course we're seeing accelerating year-over-year improvements in the rolling dividends, which I think is one of the crucial things, especially as we get into this overall climate. I'll go ahead and close the FLIR thing. And with Crane here, let me still take a look at what the SSG says. This is that analysis that I just did for FLIR. Let's do it for Crane. Make sure this is CR. Yes, it is CR here. It says CR right here. And you can see that, you know, we've got an uptick in sales. I projected it, probably limited it down. Yeah, so 18%. You know, so overall, it looks like it's taking off. The EPS doesn't look like it's, you know, overly great, but nevertheless, it's, you know, it is positive. We go down through this. We got a buy recommendation 47. We're just above the low range for this this calculation. And the thing that's probably the most important here is that with sales were trending down. It looks like they went below zero for 1 quarter on the trailing 12 months, and now they've popped up. And here, boom, we've got positive earnings and positive pre-tax profits. Even though this is trending down, it's still positive, which means that we're still gaining whatever that value is. Let's see, pre-tax profit. It's going to be 11.2%. Pre-tax profit, 11.2%. So next year or next quarter, we're expecting pre-tax profits to be, you know, whatever that trend would be, somewhere in that zone, most likely still positive. It can move a whole bunch. You know, an overall trend is a trend until it isn't, right? So nothing, you know, if nothing else, it gives you a very good idea. Sales are increasing on a trailing 12-month basis at 17%, and EPS is increasing at 20%, which is why you see these values where they are. So that's all good for CR, and my point to all of this is that the stocks that are in this accelerating, when they turn into a long or a new long, like ORIT, let's go take a look at that and just see what that looks like. Here's ORIT. Here's the this would be a setup for Tuesday, actually, right? So you've got, you know, normal noise. Look at this. This is fairly nice. I don't like the downgrade here, but boom, we've got that step increase there. That's really good. Lower left, upper right on the EPS, correspondingly with the price going up. Or coming down and then going up here. You can see that the EPS is coming down, and we've got some reasonable numbers here. Now, this is the rolling dividends, and these little spikes are not bad. What they are, they're one-time yearly payouts, and what the companies typically do is they take an excess of cash at that time and they make sure they distribute it. And ORIT, I think, okay, yeah, it's a financial company, so it might be an REIT. So if it's a REIT, a lot of times they need to dispense that cash and make sure that it's out there. So what the key is here is that we've got 3 quarters on ORIT that are in an uptick, and we can see that if we go over to its chart. Let me go ahead. This is the SSG, just like what I've done for the other stocks. And again, make sure it says ORIT. And I'm just going to scroll down to the bottom here, and you can see that we're actually upticking. This is a great acceleration pattern, and you can see that ORIT, not only is it a new long, meaning we should probably consider getting into it. It also means that the values that it's accelerating upward are just really, really good. This is a stock that would be worthy of further consideration and further analysis. Again, not a recommendation. Do your own due diligence, but it's worthwhile for you to take a look at it. All right. That being said, let's go ahead. Anything that has a green by it should be on your radar scope for looking at things. Now, all of that being what it is, this is not necessarily the greatest environment to get into stocks. And so one of the things that I think you need to take a close look at is where are we in the overall climate. As many of you know, I utilize 2 primary indicators. One of them is called the long cash ratio, which is the ratio of the long rated stocks to cash rated stocks. You just saw that. And unfortunately, with Thursday and Friday's action, we've got solid red on all measured time frames. And now what that means is that this is a moving average. Let me see if I can pull out the ribbon here. So when we take a look at this ribbon of all these different moving averages, you can see that the slope is down for most of them. And why that is a big deal is that when these things are heading down, it just doesn't make sense to buy stocks. And so what we end up with is that on all measured time frames, these things have turned negative and they're heading down. Now, you can see green precedes. So all this green that occurred up here on the right-hand side preceded all this red here. We remained green. Oops, let me kill that. We remained green in this area, but then you can start seeing we had some red appear here, and then sure enough, we started getting more red, and that caused the red over here. We've got some green that's appearing here after we turned red here. So we're kind of fluttering back and forth here. We could certainly move south more, or we could be testing the bottoms again. Friday, actually, we saw the LCR bump up just a little bit from 0.267 to 275. That's a measure of the ratio of the stocks in the database from that are long versus cash. And why that matters to me is that I keep track of the number of stocks that are on either side of that. So here I keep track of literally the new longs, the affirmed longs, etc. And by the time you do all that and you put all this together, you get 653 stocks that are rated long and 2,372 that are rated cash. So clearly we're on the downside of things. If you remember that chart that I had earlier here under metrics, we're clearly favoring a low value in terms of the number of long rated stocks, and there's a lot of fuel to take us higher, but right now is not the time to do it. And that's what the LCR, that's how I use the LCR to estimate when do I get into the market. So we've had several attempts to get in and they've all failed, and so we'll keep trying. This method works over the long haul, but obviously it gives you some failures. Now, this doesn't mean to step in 100%. I limit my exposure when let's see if I can find it here. Yep. So I limit my exposure to only 33%, so 66% cash when this first short-term column. This is a short-term, intermediate term, long-term. So basically, the fact that we're back at a cash across the board means my target position is 100% cash right now, just to reduce risk. And that's really the key here. The other thing that's telling me to be very, very careful is that this is the cumulative tick, and this is a moving average here. This is the instantaneous. Now, what the cumulative tick is a measurement when a stock transacts in this case on the New York Stock Exchange. The next price will be higher or lower depending upon supply or demand. So if somebody sold the stock and the market is flooded or getting flooded, typically prices will move down. That's a down tick, and that's represented by a down movement in the white trace here. And if you do that a lot, over 500 transactions per minute, then you get this steady movement downward. And this means that people or algorithms are selling pretty hard, because just one little tick means 500. And if you get a whole bunch of these things moving, it means that they're really selling the market hard. The converse is true also. So on Friday, we actually had some buying right out of the gates. Then it was pretty much steady state for a while, and then we took off up until, let's see, we started at about 11, and then right at noon everybody went to lunch, or 11:35, and it stayed flat until a little after 1 o'clock because everybody's at lunch, 90-minute lunch, and then it slowly moved its way up. And you can see that on Friday we actually did have some buying that occurred and went up. But the bottom line is that this is in a downtrend here. We've got to come up, and until we get a signature that looks, let me see if I can find one back here. Until we get a signature, this is back in December, where the white crosses the red from below and you get a whole bunch of buying on the exchanges. It's not prudent to move into the markets. In fact, the most recent signal you can see failed, and we crossed over right around the 8th of February, and then correlating that back to my sign here. We started getting a down signal on the 8th of February. Let's see, here's the 8th of February here. You can see the weakness starting to creep in because that was intraday. This is at the end of day. But even on the 5th of February, we actually had some indication that things were going south. And let's take a look here at the 5th. So this is the 5th in here, and you can see, sure enough, we had some indications that that things weren't good. So the bottom line is until we get this white instantaneous cumulative tick trace to cross the red from below, it's probably not prudent to move into the markets. So the bottom line, obviously we're off on President's Day on Monday, Tuesday. Even though we've got some stocks that look good, like ORIT, it's time to do some research, but I would not move in necessarily right away. Your crystal ball is as good as mine, so be careful and do your research. Thanks for listening, and we will talk to you later.